Guys and girls, welcome back to another Beaumont Outlook's fundamental educational video. And today we are discussing CPI versus PPI. So CPI versus PPI, what are they? Let's have a chat. Now, Consumer Price Index is what CPI stands for, and the Producer Price Index is what PPI stands for. And they're both measures of inflation, but they capture prices changing at different stages of production and consumption. Understanding the difference between CPI and PPI is crucial for analyzing economic health and making informed decisions. Now, when you look at CPI, which is Consumer Price Index, it measures the average change over time in prices paid by consumers for, of course, a basket of consumer goods and services. It reflects the costs of living for the average consumer. Now, components include prices for goods and services such as food, clothing, shelter, fuel, transportation, doctor and dentist fees, drugs meaning pharmaceutical, not your recreational there. Now, CPI is a key indicator of consumer inflation, which central banks closely monitor to make monetary policy decisions. High CPI readings may prompt central banks to raise rates to combat inflation, potentially strengthening the currency due to higher returns on investment denominated in that currency. Consumer spending, of course, plays a crucial role when understanding this print. Changes in CPI can influence consumer spending, which in turn affects economic growth and valuations of the currency. Now, PPI is different. PPI, which is Producer Price Index, measures the average change over time in the selling prices received by domestic producers for their output. It's a measure of inflation from the perspective of producers. To put it simply, it's basically the change in the costs it costs producers to create their goods. Components include raw materials, intermediary fees, finished goods before they reach the consumer. Indicators of producer inflation, which is PPI, can signal future consumer inflation. Now, if you've watched our previous videos of cost push versus demand pull, when PPI is increasing, what you'll realize is they will cost push onto consumers. So as we're discussing here, PPI can signal future consumer inflation, since increases in the price of goods and the producer level often lead to higher prices for consumers, cost push. Rise in PPI may indicate that CPI will also rise in the future, influencing central banks' policy, decision-making, and currency valuations. Cost pressure on producers increase. PPI suggests then that, of course, it would lead to reduced profit margins or higher consumer prices, depends how the company manage it, affecting overall economic health, stability, and, of course, currency strength. Now, when we look at CPI versus PPI, it's important to understand the timing of how these correlate with each other, the interest rate decisions behind how they will affect monetary policy, and, of course, the health and how the economic health is damaged by this. Now let's look at timing. PPI can provide early signs and signals of inflationary pressures that are coming our way as consumers. And then they get, of course, reflected in the CPI as it captures price changes at an earlier stage in the production process. Interest rates decisions are, of course, all important for us FX traders, and both CPI and PPI are closely watched by central bank when determining monetary policy. Interest rates are, of course, adjusted based on inflation expectations, and they can significantly impact currency values. Higher interest rates tend to attract foreign capital, appreciating the currency, while lower rates may lead to depreciation. From an economic health point of view, both CPI and PPI offer a comprehensive view of the economic inflationary trends. Healthy levels of inflation suggest economic growth, which can enhance the currency's appeal, whilst excessive inflation may harm the currency's value due to concerns over purchasing power, eroding and potentially causing a recession and an aggressive monetary policy tightening. That is CPI versus PPI. No need to overcomplicate it. CPI, Consumer Price Index, what are consumers paying for the baskets of goods and services? Whereas PPI, Producer Price Index, how much is it costing the producers to make those goods or make those services? Now, PPI tends to be a leading indicator for, of course, the CPI that follows it. And in summary, CPI and PPI are critical economic indicators that provide insights into inflationary trends at different stages of the economic cycle. Their implications for monetary policy and consumer spending directly influence the FX market by affecting currency demand, interest rates, and overall economic health perceptions. That has been us on CPI and PPI. Let's jump straight into the next video.